Welcome to today's deep dive into one of the hottest topics in the car-sharing industry, Turo's decision to withdraw its IPO plans. We're not just going to skim the surface. We're going to explore the financial health of Turo, what this move signifies, and what it could mean for the future of car sharing. Background: Turo's rise. Founded in 2010, Turo has grown from a niche service into a global platform, allowing car owners to rent out their vehicles in a model akin to Airbnb, but for cars. Operates in several key markets, including the US, Canada, France, Australia, and the UK, with over 360,000 active vehicles by 2024. Financial health analysis: revenue growth. Turo's revenue has seen a remarkable increase, jumping from $150 million in 2020 to a whopping $958 million in 2024. This growth showcases a strong demand for their service, especially in a post-COVID world where travel has rebounded and car ownership costs have escalated. Profitability concerns: despite the revenue spike, Turo's profitability has been less clear. While they've had positive years, the deceleration in growth rate from previous highs might indicate challenges in maintaining profit margins. Increased operational costs, including marketing, platform development, and insurance, could be eating into potential profits. Valuation and market sentiment. Turo's last private valuation was around $2.7 billion in 2023. The reluctance to go public might reflect a cautious approach towards securing a valuation that matches their growth story, or a response to a less favorable IPO market for tech startups. Profitability concerns. Despite the revenue spike, Turo's profitability has been less clear. While they've had positive years, the deceleration in growth rate from previous highs might indicate challenges in maintaining profit margins. Increased operational costs, including marketing, platform development, and insurance, could be eating into potential profits. IPO withdrawal. The decision to pull out from an IPO in February 2025 after filing in early 2022 wasn't made lightly. This move came shortly after Getaround, another car-sharing platform, ceased U.S. operations, highlighting potential market saturation or investor caution in this sector. Competitive landscape. With competitors like Getaround struggling, Turo has an opportunity to capture more market share. However, this also means they must navigate an increasingly competitive and regulatory complex environment, especially as electric vehicles and autonomous tech reshape car usage. User and host impact. For Turo's community of users and hosts, this might translate into a more stable, possibly more innovative platform. Without the immediate need to appease public market investors, Turo might be able to experiment with new services or improve existing ones. Strategic implications. Focus on long-term value. By not going public, Turo can focus on long-term strategies without the pressure of quarterly earnings. This might involve investments in technology, expanding into new markets, or enhancing user and host experiences to solidify their market position. Operational stability. Turo's operational model is asset-light, relying on car owners rather than owning vehicles itself, which theoretically should keep costs down. However, scaling this model while ensuring quality control, insurance coverage, and customer satisfaction involves significant operational challenges. Looking forward, re-evaluation for IPO. This isn't necessarily the end of Turo's IPO story, but a strategic pause. They might be waiting for a more favorable market or until they can show consistent profitability or further market penetration. Investor perspective. For potential investors, this is a moment to watch Turo's growth and operational adjustments. If Turo can demonstrate improved financial health or a unique value proposition, it might still be an attractive investment in the future, potentially through private funding rounds or a later public offering. Industry impact. Turo's decision might influence other tech startups considering IPOs, emphasizing the importance of timing, financial stability, and market readiness. Conclusion. Turo's withdrawal from its IPO plans is a multifaceted move reflecting both caution and strategic planning. Whether this leads to a stronger Turo in the long run or indicates deeper industry challenges remains to be seen. But one thing is clear: the car-sharing sector is at a pivotal moment, and Turo's actions will be a key indicator of the direction this industry might take. What are your thoughts on Turo's strategic pivot? Should they have gone public, or is this the smart play? Let me know in the comments. Hit like if you found this analysis insightful, subscribe for more in-depth content, and ring that bell for all the latest. Until next time, peace.